Montgomery Investment Management's private credit funds have delivered standout numbers since inception, all with no loss of capital and consistent monthly income. So to break down how that's been achieved and fundamentally why private credit should be on your radar if it's not already, Roger Montgomery from Montgomery Investment Management joins me now. Welcome. Nice to see you.
Thank you for having me.
So your tagline is, "The world is volatile. Your financial future doesn't have to be."
Yeah.
How do your funds deliver on that?
So one of the funds that we distribute in Australia has had a track record of 8 years, more than 8 years now. And in that time, it's never had a negative month. In other words, there's been no volatility in returns. And that's because there's no exposure to equities. So it's actually delivered equity-like returns, similar returns to the ASX 200 over the accumulation index over that period of time if you reinvested distributions. And so it doesn't have any exposure to the stock market, but it also hasn't had any exposure to property developers. And so the headlines that you're reading about private credit, of course, relate to those exposures. So where private credit funds have come unstuck is their exposure to property developers. There's been no exposure to, for example, restaurants that have come unstuck. And it's been very conservatively managed. In other words, it's diversified across 40 sectors of the economy. No loans are very large. So there's about 13,000 loans in the wholesale fund. The average size of those loans has been about $140,000. And about 80 or 90% of those loans have a duration of less than 4 months. Now that's a big deal if you're investing in private credit. A lot of people tar private credit with the same brush, but just like the stock market, they're not all the same. And so the funds that we distribute are more diversified. They have shorter duration, which means in the event of a crisis, you're being paid back in a shorter period of time. And the loans are very small. So if an individual loan turns sour, it's not going to have a huge impact on the portfolio.
We're going to break a lot of that down
Sure.
in the next few minutes, but the private credit income fund has paid income every month for 8 years. You referenced that 8 year earlier, but how important is that track record in particular when it comes to income?
Yeah, look, what we're seeing is, here's an interesting thing. So we're fortunate to work with lots of clients who are now in retirement and well into retirement. And what we've seen is when individuals first retire, they're very interested in the stock market and managing portfolios themselves or a portfolio of equity funds. But what we've discovered is as retirees mature, so once they hit their mid to late 70s, for example, interest in volatility or their appetite for volatility diminishes. And so what this fund has offered is equity-like returns without the volatility. And we talked earlier about, having an 8-year track record with no negative months. That appeals to more and more investors because we've got this demographic avalanche, of baby boomers who are retiring now and well into retirement. And so this really is a product for its times.
So no negative months.
No negative months.
No loss of capital to date. How rare is that in today's market?
Well, if you compare it to equities, it's extremely different. We've got an extended stock market or an extended valuation narrative in the stock market at the moment. Now, you might think AI is going to transform the world, and I think it is one of the technologies that will. But historically, what we've seen is that new technologies, they tend to be good for consumers, and they tend to be actually less good for investors. And with valuation stretched at the moment, and with Trump at the helm, arguably less predictable in terms of an administration in the United States, it could be that we see more volatility in the future in equities than what we've seen in recent times. If that's the case, then it makes perfect sense to be rebalancing portfolios, taking some profit off the equity part of the portfolio and putting into something that is more defensive, less correlated to equities, and still produces an attractive equity-like return, but without the volatility.
So you've sort of illustrated how these funds mitigate risk, and part of that is duration. What is it? What's the formula for protecting investors' capital, just to be clear?
Well, it's really important to understand that in the funds that we distribute, there is protection at the loan level or at the deal level. So all loans are secured. Now, they might be secured with assets, they might be secured with a general security agreement, they might be secured with directors' guarantees or personal guarantees. So all the loans have security. So at that fundamental loan level, every loan is secured. And of course, the lenders, the originators, they're approving only loans where they believe that those loans are going to be repaid in full. But then at the structural level, there is also protection. By that I mean to say that the originators of the loans, the businesses that are sourcing the loans, then assessing the applications, and then approving the loans, they're putting, and this really is interesting and perhaps unique, they're putting up some equity into the loan portfolio as a first loss piece. What does that mean? It means that if any loan goes bad, and remember they're secured, so for a loan to go bad, they have to go into arrears, they have to be sustained in arrears for some time, then the loans are called, they're not paid back, and then the security fails as well. So in order for a loan to go bad, all of that has to happen first, which reduces the risk of a loan going bad. But if one does, the originators lose first. That equity that they've put in is at risk first. And that's another barrier to investors in the fund seeing their income diminished or seeing their capital at risk. And the other bit of security is that in the wholesale fund, the portfolio has been independently, externally rated, BBB-, which is investment grade, and the retail fund has been rated AA, which is, by the way, the same rating that Macquarie Bank has. So there's lots of security there and lots of protection.
Yeah, strong ratings from Lonsec, from SQM, and others. So investors should read those ratings as offering some sort of endorsement, a sense of security.
Sure. It's really important to understand that in the private credit space, a lot of funds are marking their own homework. In other words, they're rating themselves. What we've done and what the manager of the funds that we distribute has done is actually sourced an independent rating of the portfolio. So outside of the fund ratings, the portfolio of loans itself has been independently assessed as being AA in the case of the retail fund and BBB- in the wholesale fund.
So the income fund has returned 9.55% per annum since 2017.
That's the wholesale fund. That's right.
The wholesale fund. The core fund has returned 7.35% per annum since 2022. Is there any prospect of the manager rising up the risk profile to increase returns over time? How do they balance performance with capital preservation?
Well, that's why the wholesale fund offers that return of 9.55% historically, because it is, if you like, lower in the capital stack, whereas the retail fund is higher in the capital stack. Only the most secure loans are actually funded in that one, and so therefore it has the lower return, but a significantly higher quality rating.
For investors who already own shares in property, where does private credit fit into portfolios?
Okay, that's a really great question, because the answer to it is I think, important. And I really do believe, and I've written about this in The Australian, for example, for the last couple of years, I believe private credit is going to become a core part of investors' portfolios and an asset class in its own right. And as we can see on this particular slide here, you're being, and why is that? Because you're being offered attractive equity market-like returns. You've got all of those layers of protection. The loan maturities are really short, so if something transpires in the economy that is worrisome, well, you've got a very short duration, so the manager can rebalance the book to lend to less risky parts of the portfolio. As I said, low correlation to equities, almost negative correlation to equities. In fact, every month where the stock market has gone down in the last 8 years, the wholesale fund has produced a positive return, which is genuine diversification. And I guess finally, you've got inflation protection. So if rates do rise, there's the option, because they're floating rates, there's the option of generating a higher rate of return. So there's some protection in that environment as well.
So Roger, big picture, how do you see private credit as an asset class evolving in Australia over the next few years? I know that you believe that it will become a more mainstay of many portfolios, but do you think that we'll start to see different types of funds come to the fore? So you need to be...
It's already happening. And most importantly, I think, is because this is an asset class that is truly uncorrelated to public markets. And by that I mean, the traditional 60-40 portfolio, equities and bonds. Well, when inflation is high, their correlation is also very high. Public market bonds don't provide that ballast or that security that they're supposed to provide. And so I believe that private assets, particularly private credit, is going to be a more popular part of the mix going forward.